Question 1. Which of the following provisions in a long-term care insurance policy would typically allow for an increase in the benefit amount to keep pace with inflation? A. Non-forfeiture benefits. B. Return of premium. C. Inflation protection. D. Elimination period. Answer: C. Inflation protection. Explanation: inflation protection is a critical provision in long-term care insurance policies that allows the benefit amount to increase over time, helping to offset the rising costs of long-term care services due to inflation. This is particularly important in states like Nebraska, where the cost of care can escalate rapidly. Non-forfeiture benefits allow policyholders to retain some benefits if they stop paying premiums after a certain period. Return of premium provides a refund of premiums if the policyholder passes away before using benefits but does not address inflation. Elimination period refers to the waiting period before benefits are paid, which does not have any relation to inflation adjustments. Question 2. Mr. Thompson, a 65-year-old policyholder, is considering a claim for his long-term care policy. He has been receiving care at home due to a chronic illness. What is the most critical factor that the insurance company will evaluate in assessing his claim? A. The length of time he has held the policy. B. The type of care he is receiving. C. His current health status. D. The specific daily benefit amount stated in the policy. Answer: B. The type of care he is receiving. Explanation: when evaluating a claim, the insurance company primarily assesses the type of care being provided, as this directly relates to the benefit triggers outlined in the policy. Long-term care insurance policies typically specify the types of services covered, such as home health care, assisted living, or nursing home care. The length of time he has held the policy may be relevant but is not the primary factor for claim approval. His current health status is important but must align with the coverage provisions and types of care. The specific daily benefit amount is significant for determining payment levels, but does not determine eligibility for care type. Question 3. Scenario-based. Ms. Williams is an insurance agent in Nebraska. She has just completed a presentation for a potential client who is unsure about purchasing long-term care insurance. The client expresses concern about the complexity of the policy terms and the likelihood of needing care in the future. What is the best ethical approach Ms. Williams should take to address the client's concerns? A. Assure the client that all policies are simple and do not require further explanation. B. Recommend the most expensive policy to ensure maximum coverage without explaining the details. C. Provide a clear, detailed explanation of the policy terms, including coverage options and potential benefits, while addressing the client's specific concerns. D. Advise the client to wait until they are older to consider purchasing a policy. Answer: C. Provide a clear, detailed explanation of the policy terms, including coverage options and potential benefits, while addressing the client's specific concerns. Explanation: ethical selling practices require agents to ensure that clients fully understand their options and the implications of their choices. By offering a comprehensive explanation of the policy, Ms. Williams can help the client make an informed decision based on their unique situation and concerns about long-term care. Assuring the client that all policies are simple is misleading and could lead to misrepresentation. Recommending the most expensive policy without explanation may not be in the client's best interest and lacks transparency. Advising the client to wait does not take into account the importance of planning for potential future care needs, which can be more effectively managed when addressed early on. Question 4. Which of the following statements accurately describes the purpose of an elimination period in a long-term care insurance policy? A. It guarantees the policyholder a minimum daily benefit. B. It determines how long the policyholder must wait before benefits begin. C. It specifies the maximum amount the insurer will pay for care. D. It outlines the types of care that are covered under the policy. Answer: B. It determines how long the policyholder must wait before benefits begin. Explanation: the elimination period, also known as the waiting period, is the time the policyholder must wait after a claim is made before benefits begin to be paid. This period is crucial as it helps insurers manage claims by ensuring that only those who require long-term care for an extended duration are eligible for benefits. A minimum daily benefit is determined by the policy terms but is not related to the elimination period. The maximum amount the insurer will pay is usually defined by the policy limits, not the elimination period. The types of care covered are detailed in the policy but are independent of the elimination period. Question 5. Which federal regulation requires long-term care insurance providers to disclose certain policy information to consumers to aid in informed decision-making? A. Health Insurance Portability and Accountability Act, HIPAA. B. National Association of Insurance Commissioners, NAIC, Model Regulations. C. Affordable Care Act, ACA. D. Employee Retirement Income Security Act, ERISA. Answer: B. National Association of Insurance Commissioners, NAIC, Model Regulations. Explanation: the NAIC model regulations provide a framework for states to ensure that consumers are provided with essential information about long-term care insurance policies. This includes clear explanations of coverage, limitations, and exclusions to promote informed consumer choices. HIPAA primarily addresses privacy and security of health information rather than policy disclosures. The ACA focuses on health insurance reform and does not specifically pertain to long-term care insurance. RISA regulates employee benefit plans and does not directly govern long-term care insurance disclosures. Question 6. What is a common feature of hybrid long-term care insurance policies? A. They provide unlimited benefits for long-term care. B. They combine long-term care benefits with life insurance or annuities. C. They require a higher elimination period than traditional policies. D. They are only available to individuals over 70 years old. Answer: B. They combine long-term care benefits with life insurance or annuities. Explanation: hybrid policies are designed to offer both long-term care benefits and life insurance or annuity features, allowing policyholders to receive benefits for care while also providing a death benefit if care is not needed. This structure is appealing to consumers looking for more versatile insurance options. Unlimited benefits are not a typical feature of any policy and are subject to limits based on the specific policy terms. Higher elimination periods are not a defining characteristic of hybrid policies compared to traditional ones. Availability is not restricted by age in the context of hybrid policies, as they can be offered to a wide range of applicants. Question 7. Ms. Robert is reviewing her long-term care policy and notices that it includes a non-forfeiture benefit. What does this provision ensure for her? A. She will receive a refund of all premiums paid if she never uses the policy. B. She retains some benefits even if she stops paying premiums after a certain period. C. She can increase her benefit amount without additional premiums. D. She can convert her policy into a life insurance policy at any time. Answer: B. She retains some benefits even if she stops paying premiums after a certain period. Explanation: the non-forfeiture benefit provision ensures that if Ms. Roberts stops paying premiums, she will still have access to some benefits of the policy based on the amount she has already paid in. This provision is designed to protect consumers from losing all coverage if they can no longer afford to pay premiums. Refund of all premiums is not guaranteed. Non-forfeiture benefits typically offer reduced benefits rather than full refunds. Increasing benefit amounts typically requires an additional premium or rider, not a non-forfeiture benefit. Converting the policy to a life insurance policy is not generally a feature of non-forfeiture benefits. Question 8. What primary factor is evaluated during the underwriting process for long-term care insurance? A. The policyholder's income level. B. The types of care the policyholder has previously received. C. The policyholder's medical history and current health status. D. The policyholder's employment history. Answer: C. The policyholder's medical history and current health status. Explanation: during the underwriting process, insurers focus heavily on the applicant's medical history and current health status to assess risk and determine eligibility for coverage. This information helps insurers evaluate the likelihood of the applicant needing long-term care in the future. Income level may be considered for affordability but does not directly influence eligibility. Previous types of care received are relevant but secondary to current health status. Employment history is generally not a determining factor in long-term care underwriting. Question 9. Which of the following accurately describes a key consumer protection measure in Nebraska's long-term care insurance regulations? A. Mandatory annual premium adjustments based on age. B. Requirement for insurers to provide a free look period for new policies. C. Prohibition of any marketing materials that highlight policy limitations. D. Automatic policy renewal until age 75. Answer: B. Requirement for insurers to provide a free look period for new policies. Explanation: Nebraska regulations include a consumer protection measure that mandates insurers to offer a free look period, allowing policyholders a specified time to review their policy and cancel it for a full refund if they are not satisfied. This period typically lasts 30 days. Mandatory annual premium adjustments based on age are not a consumer protection regulation and they vary by policy. Prohibiting marketing materials that highlight limitations is impractical. Regulations focus on accurate representation rather than censorship. Automatic policy renewal until age 75 is not a standard requirement in Nebraska's long-term care regulations. Question 10. Mr. Johnson, a potential long-term care insurance buyer, is concerned about the impact of inflation on his future care costs. Which policy feature should he specifically inquire about to address this concern? A. Benefit triggers. B. Inflation protection. C. Elimination period. D. Non-forfeiture benefits. Answer: B. Inflation protection. Explanation: inflation protection is a critical feature that allows policyholders to adjust their benefits over time to keep pace with inflation, ensuring that their coverage remains adequate as care costs rise. This feature is essential for Mr. Johnson to consider given the long-term nature of care needs. Benefit triggers define when benefits start but do not address cost increases. Elimination period refers to the waiting period before benefits are paid unrelated to inflation concerns. Non-forfeiture benefits pertain to what happens if premiums are stopped but do not cover inflation adjustments. Question 11. Which of the following is not typically a requirement for obtaining a long-term care insurance policy in Nebraska? A. Completion of a medical questionnaire. B. Proof of income. C. Disclosure of any pre-existing conditions. D. Undergoing a medical examination. Answer: B. Proof of income. Explanation: when applying for long-term care insurance, applicants are generally required to complete a medical questionnaire and disclose any pre-existing conditions to assess risk. However, proof of income is not typically a standard requirement for obtaining a policy. The underwriting process focuses more on health status than financial means. Completion of a medical questionnaire is standard to gather relevant health information. Disclosure of pre-existing conditions helps insurers understand potential risks associated with insuring the applicant. Undergoing a medical examination may be requested but is not universally required, as some policies may allow for simpler underwriting processes. Question 12. In Nebraska, which entity is responsible for overseeing the compliance of long-term care insurance providers with state regulations? A. National Association of Insurance Commissioners, NAIC. B. Nebraska Department of Insurance. C. Federal Insurance Office, FEO. D. Centers for Medicare and Medicaid Services, CMS. Answer: B. Nebraska Department of Insurance. Explanation: the Nebraska Department of Insurance is the regulatory body responsible for ensuring that long-term care insurance providers comply with state laws and regulations. This includes licensing insurers and overseeing their practices to protect consumers. NAIC provides model regulations but does not enforce them at the state level. Federal Insurance Office focuses on systemic risks in the insurance industry but does not regulate long-term care insurance. CMS primarily oversees Medicare and Medicaid, not private long-term care insurance. Question 13. What is the primary purpose of the Health Insurance Portability and Accountability Act, HIPAA, in relation to long-term care insurance? A. To regulate the pricing of long-term care policies. B. To ensure the confidentiality and security of health information. C. To standardize the benefit amounts across policies. D. To require long-term care providers to offer insurance policies. Answer: B. To ensure the confidentiality and security of health information. Explanation: HIPAA establishes regulations to protect patients' medical records and other personal health information, ensuring confidentiality and security. In the context of long-term care insurance, it is essential that insurers and providers handle health information with care to comply with these regulations. Regulating pricing is not a function of HIPAA, it focuses on privacy and security. Standardizing benefit amounts is not within the scope of HIPAA's regulations. Requiring providers to offer insurance is outside the purview of HIPAA. Question 14. Which of the following is a potential disadvantage of purchasing a traditional long-term care insurance policy? A. Premiums may increase over time. B. Benefits are available immediately after purchase. C. There are no age restrictions for eligibility. D. Coverage can be tailored with numerous riders. Answer A. Premiums may increase over time. Explanation. One significant disadvantage of traditional long-term care insurance policies is that premiums can increase over time, potentially making them unaffordable as policyholders age. This variability can lead to financial strain if premiums rise significantly. Immediate benefits are not a feature of traditional policies, and there is typically a waiting period. No age restrictions may apply, but underwriting criteria generally consider age as a risk factor, and numerous riders allow for customization, which is an advantage, not a disadvantage. Question 15. When comparing hybrid long-term care policies to traditional long-term care insurance, what is a primary advantage of hybrid policies? A. They do not require any health screening for eligibility. B. They guarantee a death benefit if long-term care is not needed. C. They are typically less expensive than traditional policies. D. They provide unlimited benefits for long-term care services. Answer. B. They guarantee a death benefit if long-term care is not needed. Explanation. Hybrid policies combine long-term care benefits with life insurance or annuities, ensuring that if the policyholder does not utilize the long-term care benefits, their beneficiaries will receive a death benefit. This makes them appealing for those who want to ensure their premiums do not go to waste. No health screening is generally not true. Most hybrid policies still require some level of underwriting. Less expensive is not necessarily true, as hybrid policies can be more costly due to their combined benefits. Unlimited benefits are not a standard feature of hybrid policies. Question 16. Which of the following describes a benefit trigger a long-term care insurance policy? A. The age at which coverage begins. B. The condition under which benefits will be paid. C. The method by which premiums are calculated. D. The duration for which benefits are available. Answer. B. The condition under which benefits will be paid. Explanation. A benefit trigger is a specific condition outlined in the policy that must be met for the insurer to begin paying benefits. Common triggers include the inability to perform certain activities of daily living, adults, or a cognitive impairment diagnosis. The age at which coverage begins is unrelated to benefit triggers. It relates to policy terms. Method for calculating premiums is based on underwriting factors and not tied to benefit triggers. Duration for which benefits are available is determined by the policy terms but does not define when benefits are triggered. Question 17. What is the purpose of inflation protection a long-term care insurance policy? A. To provide a fixed benefit amount throughout the policy term. B. To adjust benefit amounts over time to keep pace with rising costs of care. C. To waive the elimination period for policyholders over a certain age. D. To reduce premiums if the policyholder is in good health. Answer. B. To adjust benefit amounts over time to keep pace with rising costs of care. Explanation. Inflation protection is designed to increase the policy benefits to keep up with the rising costs of long-term care services due to inflation. This feature is vital for ensuring that benefits remain adequate over the duration of the policy, especially given the increasing cost of care. Fixed benefit amount would not account for inflation, which is contrary to the purpose of inflation protection. Waiving the elimination period is not related to inflation protection. Reducing premiums based on health is not a function of inflation protection. Question 18. What key factor influences the underwriting decision for a long-term care insurance applicant? A. The applicant's retirement savings. B. The applicant's family medical history. C. The applicant's job title. D. The applicant's marital status. Answer. B. The applicant's family medical history. Explanation. Family medical history is a critical factor in the underwriting process for long-term care insurance because it provides insight into potential hereditary health risks. Insurers evaluate this information to assess the likelihood that the applicant will need long-term care in the future. Retirement savings may indicate financial preparedness but do not directly impact health risk. Job title generally does not reflect health risk associated with long-term care needs. Marital status is typically not a deciding factor in underwriting decisions. Question 19. Ms. Garcia is evaluating different long-term care insurance policies. Which of the following should she consider as an indicator of a quality insurance provider? A. The insurer's market share in the industry. B. The insurer's claims paying history and consumer reviews. C. The variety of policies offered. D. The length of time the insurer has been in business. Answer. B. The insurer's claims paying history and consumer reviews. Explanation. An insurer's claims-paying history reflects its reliability and ability to fulfill its obligations to policyholders. Consumer reviews provide insights into customer satisfaction and service quality, making them essential factors in assessing the quality of an insurance provider. Market share may indicate size, but does not necessarily reflect quality or reliability. Variety of policies offered can be a factor, but it does not guarantee the quality of service or claims fulfillment. Length of time in business is relevant, but not as critical as actual claims performance and consumer experiences. Question 20. Which of the following is a common alternative to long-term care insurance that individuals might consider? A. Medicare. B. Disability insurance. C. Life insurance. D. Health savings accounts (HSAS). Answer: D. Health savings accounts (HSAS). Explanation: Health savings accounts (HSAS) can serve as an alternative funding mechanism for long-term care needs, allowing individuals to set aside money tax-free for qualifying medical expenses, including long-term care. While HSAs are not a direct substitute for long-term care insurance, they can complement personal savings strategies. Medicare primarily covers acute care and rehabilitation, not long-term care services, thus not serving as an alternative. Disability insurance replaces income rather than covering long-term care costs. Life insurance does not directly provide for long-term care needs unless it has a long-term care rider. Question 21. When evaluating long-term care insurance policies, which of the following provisions is most important for ensuring continued coverage despite changing health conditions? A. Non-forfeiture benefits. B. Guaranteed renewability. C. Waiver of premium. D. Benefit trigger definitions. Answer: B. Guaranteed renewability. Explanation: Guaranteed renewability is a provision that ensures the policyholder can renew their policy regardless of changes in health status. This is crucial because it protects against the risk of being denied coverage if health deteriorates after the initial purchase. Non-forfeiture benefits refer to options available if a policy is cancelled but do not guarantee ongoing coverage. Waiver of premium applies in specific situations, such as when receiving benefits, but does not address overall renewability. Benefit trigger definitions relate to when benefits become payable but do not influence the ability to renew a policy. Question 22. Which of the following scenarios exemplifies a situation where a long-term care insurance policy may impose an elimination period? A. A policyholder is hospitalized for 30 days before transitioning to a rehabilitation center. B. A policyholder requires assistance with 2 activities of daily living adults immediately upon policy activation. C. A policyholder receives a diagnosis of cognitive impairment after filing a claim. D. A policyholder begins receiving care in an assisted living facility shortly after purchasing the policy. Answer A. A policyholder is hospitalized for 30 days before transitioning to a rehabilitation center. Explanation: An elimination period is the waiting time between when a policyholder becomes eligible for benefits and when the insurer begins paying out claims. This period often begins when the policyholder starts receiving care, such as after hospitalization. If the policyholder is hospitalized for 30 days, they might have to wait an additional period before benefits kick in. Assistance with a DLSI trigger benefits immediately if defined in the policy. The elimination period does not apply here. Cognitive impairment diagnosis may qualify for benefits but does not relate directly to the elimination period unless care starts afterward. Care in an assisted living facility typically does not trigger the elimination period unless the policy specifies otherwise. Question 23. Which of the following describes an advantage of having optional riders in a long-term care insurance policy? A. They simplify the application process. B. They provide flexibility in coverage based on individual needs. C. They lower the overall premium cost significantly. D. They eliminate the need for underwriting altogether. Answer: B. They provide flexibility in coverage based on individual needs. Explanation: Optional riders allow policyholders to customize their coverage according to specific needs, such as adding inflation protection or a return of premium feature. This flexibility ensures that individuals can tailor their policies to better suit their future care requirements. Simplifying the application process is not a characteristic of optional riders, as they may complicate the understanding of the policy. Lowering overall premium costs is not guaranteed with riders, as they can often increase premiums. Eliminating underwriting is not a feature of riders, as underwriting is typically still required regardless of additional options. Question 24. Mr. Thompson is considering purchasing a long-term care insurance policy but is concerned about potential premium increases. Which option can he choose to mitigate this risk? A. Select a policy with a lower daily benefit amount. B. Opt for a policy with inflation protection. C. Choose a policy with a shorter benefit period. D. Include a non-forfeiture benefit rider. Answer: B. Opt for a policy with inflation protection. Explanation: choosing a policy with inflation protection helps ensure that benefits will increase over time, which can mitigate the financial impact of premium increases relative to the rising cost of care. This is essential for maintaining adequate coverage as expenses grow over the years. Low daily benefit amount may reduce initial premiums but does not prevent future increases. Shorter benefit period may also lower premiums but does not address the issue of rising care costs. Non-forfeiture benefit rider provides options if the policy lapses but does not prevent premium increases. Question 25. Under the Nebraska long-term care insurance regulations, which statement is true regarding marketing practices? A. Insurers can use misleading statements to promote their policies. B. Insurers are prohibited from using the term Medicare supplement for long-term care products. C. Insurers must provide a clear comparison of their products to similar offerings. D. Insurers are allowed to guarantee policy renewal based solely on age. Answer: B. Insurers are prohibited from using the term Medicare supplement for long-term care products. Explanation: under Nebraska regulations, insurers must avoid misleading terminology. Since Medicare supplement policies are distinct from long-term care insurance, using such terms for marketing long-term care products is prohibited to prevent consumer confusion. Misleading statements are not permissible under any regulations, and this would violate consumer protection laws. Providing a clear comparison is not a mandated requirement, but transparency is encouraged. Guaranteeing renewal based solely on age is not allowed. Insurers must consider other health factors as well. Question 26. Which of the following factors would most likely disqualify an applicant from obtaining a long-term care insurance policy? A. A diagnosis of arthritis. B. A recent hip replacement surgery. C. A history of mild cognitive impairment. D. A history of well-managed diabetes. Answer: C. A history of mild cognitive impairment. Explanation: a history of mild cognitive impairment is a significant risk factor in the underwriting process for long-term care insurance, as it indicates a potential future need for care. Insurers may view this as a disqualifying condition because it suggests that the applicant may require assistance sooner than those without such a history. Arthritis is common and often manageable, making it less likely to disqualify an applicant. Hip replacement surgery may not be a disqualifying factor if the applicant has recovered and is in good health. Well-managed diabetes typically does not preclude individuals from obtaining coverage, especially if they are stable. Question 27. If a long-term care insurance policy includes a return of premium rider, what benefit does this provide to the policyholder? A. It allows the policyholder to receive benefits immediately. B. It refunds a portion of the premiums if the policyholder does not use the benefits. C. It reduces the monthly premium cost significantly. D. It guarantees the policyholder's eligibility for benefits regardless of health status. Answer: B. It refunds a portion of the premiums if the policyholder does not use the benefits. Explanation: a return of premium rider ensures that if the policyholder does not utilize the long-term care benefits during their lifetime, they or their beneficiaries will receive a refund of some or all of the premiums paid. This feature adds a layer of financial security for policyholders. Immediate benefits are unrelated to this rider. It concerns the return of premiums. Reducing monthly premium costs is not a characteristic of the return of premium rider. It may actually increase premiums. Guaranteed eligibility for benefits is not provided. Underwriting still applies regardless of this rider. Question 20. What role does the elimination period serve in a long-term care insurance policy? A. It allows for a predetermined amount of time before benefits begin after a claim is filed. B. It determines the maximum length of time benefits can be paid. C. It sets the minimum age for policyholders. D. It defines the conditions under which benefits can be paid. Answer A. It allows for a predetermined amount of time before benefits begin after a claim is filed. Explanation: the elimination period, often referred to as a waiting period, is the duration between when the policyholder becomes eligible for benefits and when the insurance company starts paying out those benefits. This period can vary by policy and is designed to help insurers manage risk and costs. Maximum length of time benefits are paid is not determined by the elimination period. This is defined elsewhere in the policy. Minimum age for policyholders is not specified by the elimination period. Conditions for benefits are defined by benefit triggers, not the elimination period. Question 29. Which of the following is a critical consideration when choosing long-term care insurance in Nebraska? A. The insurer's advertising budget. B. The specific benefit amounts and duration of coverage. C. The insurer's corporate headquarters location. D. The availability of group insurance plans. Answer: B. The specific benefit amounts and duration of coverage. Explanation: when selecting a long-term care insurance policy, understanding the specific benefit amounts and the duration of coverage is vital. This consideration directly impacts how well the policy will meet future care needs and how much financial protection it will provide. Insurers' advertising budget has no bearing on the policy's quality or suitability. Corporate headquarters location does not influence policy benefits or service quality. Availability of group insurance plans is not universally applicable and may not provide the same level of customization as individual policies. Question 30. In Nebraska, what is the primary function of the National Association of Insurance Commissioners (NAIC) model regulations concerning long-term care insurance? A. To enforce state insurance laws directly. B. To provide guidelines that states can adopt to standardize regulations. C. To approve all long-term care insurance policy forms before they are sold. D. To set the premium rates for long-term care insurance products. Answer: B. To provide guidelines that states can adopt to standardize regulations. Explanation: the NAIC develops model regulations to help states establish uniform standards for long-term care insurance. These guidelines encourage states to implement consistent consumer protections and ensure policies are written and marketed in a fair manner. However, the NAIC does not have the authority to enforce laws directly. Enforcement is a state responsibility. Enforcing state insurance laws directly is not within the NAIC's jurisdiction. It provides recommendations rather than enforcement. Approving policy forms is also a state responsibility. The NAIC does not have the authority to approve individual insurance products. Setting premium rates is determined by state regulators, not the NAIC, which only provides a framework for regulations.